All right, folks, welcome back. This is our Thursday, January 20th, 2022 commentary, and we're looking at the dollar index daily chart. So we're looking for the buy side liquidity in here to be tagged, maybe run up into these relative equal highs, and then up here. I think a lot of the concern about potential war with Russia invading Ukraine, Taiwan, and China, there are so many saber rattling events going on, and the stock market sell off today. The idea of running to safe haven, and I understand that probably doesn't sound all that convincing because of the turmoil we have in our own country, but the greenback tends to be the flight to safety. Okay, so we're seeing some bullishness here. If we have an event that comes out like a wartime event, something pops off, that could really supercharge the dollar index to go higher. And I'm looking longer term up in here still, but taking it one stride at a time here. Buy side, discount low, consequent encroachment, and best case scenario, we'll just aim for the 98 big figure. I'm not saying it's going to go there, but that's what I'm submitting to, okay? All right, so we had the market trade down into this balanced price range. So we had one candle go down, one candle go up, and there's a range in between both of them. The market trades down into that, rejects it, and sends it higher today. Okay, and I mentioned I would talk to you about balanced price ranges, and this is a bullish balanced price range. Dollar index hourly chart, buy side here, ran up into that today. I mentioned how we could potentially trade back down to this premium high, but didn't need to. Accumulated in here, which we'll look at on the 15-minute time frame. Next buy side liquidity pools here, relative equal highs up here. 15-minute time frame on the dollar index. You can see the relative equal highs in here. Just punched right up into that today. Again, balanced price range. Single candle down, single candle up. There's a range in between both. It digs into that and then rallies. And just remember, the examples I'm showing you here, after I teach you in the lecture portion of this video, go back and look at these time frames I'm referring to here and to get a better view of what it is I'm going to describe. Fair value gap over here with the bullish order block. We traded down into that 1, 2, and 3 times here, and then rallied up rather strongly. Euro dollar daily chart. I mentioned this was heavy. I'm looking for it to go lower. We traded up into the CIBI in here. So we trade up into that. Institutional order flow entry drill and sells off. Looking for it to trade down below here. Short-term objective is the liquidity resting below here. Euro dollar hourly chart. I mentioned last night we've basically rebalanced all this. There's really no need for it to go any higher. And it did punch a little bit higher, but rolled over. Market structure break here. Returns back up into mean threshold. Just a little bit above mean threshold there. The bearish order block. Then sells off. Attacks the sell side liquidity here. And I drew your attention over here. I'm still favoring that here. I might even get that tonight or into New York session tomorrow. All right, 15-minute time frame on euro. Okay, we had a run above buy side here. Break in market structure. Trades back up in. Optimal trade entry. Breaks again. Balanced price range. Single candle up. Single candle down. In this range, that's what I'm drawing your attention to. That little pocket of price action where it just overlaps, like one up, one down. Okay, and it tends to be a stiff barrier there. They don't generally tend to completely fill in. And I'll give you the reasons why I think that's the case. And I'll give you the logic in the teaching portion as to why that is the case. But we took out sell side liquidity here. Really nice run lower on euro. British pound, like I said, I mentioned I'm not interested in this pair. Seeing some students mention in the forum, either last night or today, I'm not sure exactly when it was posted, but it was recent in regards to why I'm not in love with cable. It's just too many things that it's doing that I don't like, and because I don't like the delivery I'm not in tune with it right now. I'm avoiding it. Okay, I can't make it any plainer than that because I can't get a good read on what it's trying to do. I have to leave it on, otherwise I'm gambling. And we're going to leave it at that. I think, ultimately it should drop lower if we have higher dollar, but nothing in here except for the order blocks have my attention, and you can mark them off at the opens on each of these as potential downside objectives. All right, pound dollar hourly. Ran buy side out here. Almost took out this high and then broke down. And again, relative equal lows, higher low to the right. That's low resistance liquidity run signatures there. And then over here, I like this area here. So 135.30, 135.20-ish. That could be a downside objective. 15-minute time frame on pound. All right, so we had, again, the market run above previous day's high. Breaks down. Returns back up in. Institutional order flow entry drill here with the wick. Don't close in this SIBI. We see it here. Breaks lower, attacks the sell side here, and the sell side resting below these relative equal lows. All right, E-mini S&P March contract. This is the hourly chart. Bearish order block, buy side liquidity rallies up into that today after taking out the low. And these are old lows. So these prices, if you look at your daily chart, you'll see what these are. It's pretty obvious what they are. There's no sense in me taking up to a daily chart. You can do some homework for that. So we trade a premium array, and we break down, attack the sell side here. So this is a market maker sell model, more specifically anchored in here. And we'll look at that when we drop down into the 5-minute chart. So we have 8:30 to 4:15 New York local time. The market rallies up, market maker sell model, hits the bearish order block as I just outlined. Smart money reversal, low risk sell, first stage distribution, second stage distribution. Look at that. Beautiful fair value gap. Beautiful, isn't it? Trades right up into it, hammers it. Then Armageddon. Sell side here, here, the old lows respective to the daily chart. And these levels down here, and I apologize, I meant to put the identifiers on in terms of what these levels are. If you look at the daily chart, there's a volume imbalance. The first one that you would come to as it's dropping below the 44.85 level. I wish I would have had it noted in the chart here, but it's actually a good exercise for you to go in and look at the daily chart. And the symbol again for this is ESH for Harry 2022, and you'll get the March E-mini S&P futures contract. This level here is again a fair value gap, and there's another fair value gap just below this one, but I didn't have it noted because I felt this was enough for the chart example today, and it actually just rolled over even more down below the 44.40 level. So just a really nice decline. But this we've been calling obviously S&P lower, stocks lower. I mentioned that this is where the volatility is. Forex is kind of slow right now. And this is the benefit of being in mentorship, where we know how to segue from one asset class to the other. If something's quiet, that's okay. You can take your attention over to the asset class that is being utilized right now. And everybody's getting hammered in stocks. All right, ICT balanced price ranges. Okay, now I'm going to give you an example of a bullish price range that's balanced and a bearish price range that's balanced. And I'll explain to you what the logic is behind it and why it's what it is today. All right, so on the left, we have a bullish balanced price range. And what I want you to think about is the market has to have some reason to want to turn down here. Now, it could be some kind of a discount array like a fair value gap or a bullish order block, or it's trading below an old low and takes sell side out before it rallies while you're in a market it's predisposed to go higher, in which it's already bullish. Then you have this gap here, and you have this gap here. Now, I purposely drew this out because I want to give you the internal dialogue of what I would expect to see on this candle here. A wick or tail would trade down into this partially, this range here, this little area here between this candle's low and this candle's high, and this candle's high and this candle's low. There's a balanced price range. They don't have to be identical. That's not one of the hallmarks to this. What this actually is, and it's a byproduct of markets becoming electronic, okay, and or 24 hours. In the old days, when I began trading, I was in the futures market, and I mentioned this the other day. These markets had sessions where they would open and close, and then there would be no trading. And the next day, wherever they opened up was like the lottery. Who knows where it was going to be? And it would create gaps. And if you could use a little bit of your imagination here, imagine this candle here not even being there. And then imagine this candle here not being there as well. So you'd have 3 candles down here with a gap between this candle's high and this candle's low, and a gap between this candle's low and this candle's high. So this candle doesn't exist and this candle doesn't exist. What you would end up with is a market that's declining, then a gap where no price trading was offered, and then 3 candles down here all by themselves, isolated, then a gap in here, no candle, and then the lowest of this candle would be here. So there would be missing data in this area here. What that actually is, and what it's transitioned into, is a old classic chart pattern. It's a reversal pattern called an island reversal. Okay. Now I already know some of you in here, they're very cynical. Okay. And you're running around with people that are just nuts, and they're making up things about me, and they're terrible, and they're not even true, and they like to make up nonsense about me. And I know you're in here. Okay. But I want you to understand, I'm not renaming the island reversal because it becomes a balanced price range when there is market hours available. Okay, so it becomes a balanced price range because it's doing the very thing that if it wasn't trading electronically or with 24-hour trading, you would have actual gaps here. Okay, and I'll take you into Google and show you what an island reversal looks like. But once you see it, you'll say, oh, it makes sense. I understand now. But the logic has to be hinged on the fact that this is likely to turn and go higher anyway. Because without that, there's really nothing to associate a balanced price range on. Then it becomes like a fair value gap or institutional order flow entry drill. Okay, so this is the delineation between those other 2 arrays, which is, again, institutional order flow entry drill or fair value gap. Fair value gap is subdivided into BISI or SIBI, but balanced price range is hinged on the logic that if it's a bullish balanced price range, there has to be some logic as to why it turned here. And then you would visually see this as an island reversal where candles would be isolated after. In other words, it's dropping lower, then it gaps down in severe like capitulation, where the market just pukes up its guts. I apologize for that, but that's essentially what it's done. And it goes down there and it spends a few candles, and then all of a sudden there's some remorse to that, and it gaps up over here. So that would create a gap here and a gap here. Very valid turning point. Okay, it really communicates that there's some bullishness there. So if you trade down into this, it tends not to fill. So it creates many times the support structure behind an institutional order flow entry drill that would be bullish, and leaving that gap open, which we would like to see become what? A breakaway gap. So how all these things dovetail together. Now, everything I just gave you here for the bullish balanced price range is obviously reversed for a bearish balanced price range. The logic is there has to be some kind of reason to expect it to be turning lower up here, some kind of premium array. Bearish order block, old high it runs through when you're bearish and looking for a run on stops. And then you have this area here, between this candle's high and this candle's low, that little area right there, matched up with over here with a candle low and candle high, that range in between with this area here, that's the balanced price range. So again, with this island reversal idea, which is an old classic chart pattern, but nobody really talks about it anymore because it doesn't form. I mean, it can form on stocks, but it doesn't form on like Forex because there's always trading. Like it's always trading 24 hours a day. So it won't create these gaps where it creates just a small little pocket or collection of like 3 candles. It doesn't necessarily mean 3 candles always. It could be really, 5 or 6 or 10, depending upon what it's done, that led to the gapping up there. And it holds it for a little while, and then all of a sudden it gaps down here. So you would have the trading at this candle here that closes, and these candles don't have to be up or down. It's just the logic is the balanced price range here when it's bearish. Okay, and then you would take these candles out internally when you look at price, and I would see this as an island reversal that's bearish. So any wick that goes up on this candle here that trades into this balanced price range, it should be kept at bay and not allow it to trade too much into this range, because it's already shown a willingness to discount this whole business here and say, okay, this is overdone. Let's get back to fair value as quick as we possibly can. Not fair value in the sense of the PD array, but fair value in terms of valuation for whatever that asset class is. Okay, so let me go over to Google and I'll show you what this pattern really is hinged on, which is an old classic chart pattern that has transitioned into what I call a balanced price range. So I named it this because the logic is what I'm showing you here and what I teach, but it's really hinged on the same premise that that old pattern was based on, which is an island reversal. It's kind of a corny name, but when you see the chart example, you'll know right away why they named it that. So let's go over to Google real quick. All right, if you go into Google and you put in bullish island reversal pattern, you'll get examples, something like this here. Okay, see how you have a gap and you have a gap over here, and all these candles stay down here away from the decline. Then it was an extreme gap. They show another gap in here, but it's this whole collection of price action, and then it gaps away. So it creates this island of candles all isolated by itself away from the order flow up here and the order flow here. So when I'm looking at these ranges that show one single pass down and one single pass up, I internalize it with this logic. So in other words, the market was taken down to a really, really deep discount price, then it gaps away. So and it comes down into this level. I'm not looking for it to run back below this low because it's already shown a willingness to accumulate longs in here and then quickly move away from that. And that's the benefit of knowing what a balanced price range is. And the reverse would be something like this up here, where it goes higher. Let me see if I can make it bigger by clicking on it. And not by much, but it's good enough. So the market's been rallying, then it gaps up, creates 1, 2, 3, 4, 5 candles, and then it gaps lower. This becomes the balanced price range on a 24-hour or electronic market. But this is old logic that doesn't really exist anymore until you look at it like a stock, because they stop trading and they open up somewhere else. There's a pause in trading. Electronic markets are not going to be able to show that much or that clearly like this. So we'll see candles that have to mark price action by time, and it records that because of the continuous trading. But the logic is what's being associated with this gap up. It should be expected as being bearish anyway, and then it gaps down. So any rally back up into this should be met with resistance. Okay, so hopefully that's been insightful to you. It helps bring clarity to what it is the balanced price range is, why you're looking for it, what's the purpose for it. And I will touch base with you tomorrow in our weekend commentary. Until then, be safe.